When you are running a marathon, you don't just run 10 miles in your first attempt. You start with 6 miles, then improve your track to 7 miles, and then gradually you hit that 10-mile spot. Many people see achieving $1,000 of dividend income as one uphill task because they're focusing on the top. But what if we look at it as a hill and focus on hiking to the top of it? What if we start by achieving checkpoints instead of dreaming to accomplish it all in a single go? The same applies to our financial well-being. If we start by investing in stocks and then gradually compound our dividend income by reinvesting, then our goal can be just a mile away instead of 10 miles at the beginning. In this video, we're bringing for you guys a guide to dividend investing and how you can earn $1,000 of passive income per month. Welcome to 5-Star Finance. Passive income is all about money without doing work. But one bit of work which you have to do is learning about dividend investing the right way. $1,000 of free money can be a decent enough objective to accomplish every month if you are young. But most of the people are dependent on old ways of achieving their financial goals, which are not the ideal ways of doing it. But in this video, we're going to teach the right way of achieving your financial goals through dividend investing. So sit back and enjoy. Many people think about the milestone of earning more than $1,000 per month in dividends, and they start thinking that they'll never get there. But that's far from reality. Clearly, these people have not been told about the eighth wonder of the world known as compound interest. Now, firstly, don't think that you'll start and immediately you get your hands on $1,000 per month in dividends. You start small. You start rolling with that snowball that initially fits in your hand, but as you push it down the hill and it gets momentum, it gets far easier to accumulate some serious wealth over time. For example, you may start with just a couple of shares of a certain stock that pay $1 or $2 per month, but then that $1 or $2 starts to grow over time. The real game begins when you reinvest those sums to gain even more shares over time, and eventually it becomes easier and bigger as time goes along. So how do we pick those great quality stocks that are going to help us achieve $1,000 of dividend income per month? There are a couple of things you need to remember before even thinking of buying some stocks. Let us take the McDonald's stock as an example. Now, the very first thing you want to look at is the forward dividend and the payout ratio. So what actually the forward dividend is the amount of money you're going to receive from the company every year. Let's just suppose that in the case of McDonald's, all you're receiving is $5 and that's it. Yes, it's not much, but don't forget the principle we discussed earlier on, and that is the compound interest which is capable of pulling off amazing results for you. All you have to do is get that snowball off and running. So if the forward dividend is $5, this gives McDonald's a dividend yield of 2.30%. Now the next thing you want to look at is their earnings. Now let's suppose that the company earns $6.33 from every share, and they're paying out $5 of that in the form of dividends. The remaining $1.33 is reinvested in the company. Now you need to look out that the earnings should be always greater than the dividends they're giving out, because you don't want them paying out more than what they're earning, because if that happens, that means they're digging into their balance sheet and savings to pay out. The other thing you want to look out for before setting out on a voyage to buy some stocks is to look at the dividend paying history of the corporation. Take the Coca-Cola stock for instance. You might love the fizzy drink, but once you look at the profound dividends that have been coming from a long time, you might love the company altogether. Coca-Cola have increased their dividend payouts consistently over the last 59 years. Now that's some straight up consistency. At this moment, Coca-Cola pays a 3% dividend, which is quite good. The company also has a decent growth rate because it is already up 25% in the course of the last 5 years. You might be wondering that a 3% dividend is not a big deal, right? It might not be, but it's the reliability that's the big deal. Another aspect of this company being really safe to invest in is that they've dominated the whole beverage industry for quite a while now, and that is all which matters. Warren Buffett, the greatest investor of all time, also has his money invested in this corporation. No matter if you start small, start by buying a small amount of shares of this company. But once you start adding up to your investments consistently, that is where the growth begins. The next thing centers around what we often see most investors miss, and that is the quality of the company and the ability to contemplate how the company is going to look in the coming years. This factor is of paramount importance, because if you're not looking at the quality of the business model, you're bound to lose your money. As Warren Buffett says, buy companies with a strong competitive advantage. The thing is, you don't want to jump right into those posh and expensive stocks right after you start investing. You can always look for cheap stocks. And what do we mean by cheap? It's the relation between value and price. The real value of the company and the price the stock is currently selling in the market. Just think about how much passive income you can generate by consistently buying dollars for cents every month. If you want to achieve this goal of earning more than $1,000 of dividend income a month, you need to get into the habit of investing. You need to save some money from every paycheck that comes in, instead of getting overexcited to spend all of that money away. The investing mindset is totally different from the regular mindset. The regular mind will get some instant gratifications, but the investing mindset will get long-term goals like $1,000 of dividend income. It's passive income versus feeling good for a short period of time. Just make the decision about which person you want to be and then pursue it. Now, let us show you some stocks which are a good place to start if you want to focus solely on passive income. And those are the dividend aristocrats. An example in the dividend aristocrats list is 3M, with a dividend yield of 3.5%. And the thing about 3M is that they have increased their annual dividends consistently for over 61 years. Currently selling at $170 per share, with a market cap of over $100 billion, another company you can start with is PepsiCo, a very well-known company with a dividend yield of 3%. They've increased their dividends for over 48 consecutive years. You might be thinking that they own the Pepsi beverages and that's all, but that's just the start. PepsiCo produces products like Lay's, Gatorade, Doritos, Mountain Dew, and a bunch of other billion-dollar brands, which makes it a strong company to hold. Note that we are not recommending these stocks, but they are both part of the Dividend Aristocrats list and can help you compound passive income. Understanding stocks is a big step towards achieving some passive income over the long term. Those who don't understand stocks simply end up losing a lot of their money. That is the reason why we've provided a free guide for you in the description below, which will help you understand the 6 stock categories and which of the categories are the best for building passive income and how you should analyze them. It's not as obvious as you think, so take action now and grab your free copy of the 6 stock categories guide and start building your passive income list to invest in stocks in the correct way. Check out the video we've handpicked for you and we'll see you in the next one.